I'm Tommy Humphreys on behalf of Kitco and Cambridge House, coming at you live from the California Resource Investment Conference. I'm very pleased to be joined by Greg Weldon. Greg is a commodity trading advisor and also the author of Weldon Financial macro and technical newsletter that we're very pleased to have him here because he's the newsletter writer that all the newsletter writers and hedge fund managers read. And anyway, Greg, thanks for being here.
My pleasure.
Tell me, what's your take on the markets right now? Where are we? What are you worried about?
Well, I mean, this may be one of the most interesting times in our era for sure. Since 2008, central banks have taken on the responsibility of ensuring that we don't enter a debt deflation, which would likely lead to an economic depression. So they've been very aggressive in adding liquidity when necessary to stave that kind of scenario off. Where we're at right here is, the Fed has wound down QE2. The ECB has kind of picked up the torch. The problem I have with the ECB is it's a 3-year term on their liquidity ad, which just pushes this problem down the road. So I fear that if central banks don't remain as aggressive as they have been, that this could precipitate another crisis, in which case that would force them to act even more aggressively. End game net is likely higher commodity prices, higher precious metals prices, because ultimately central banks will be forced to continue to pump in money at a very aggressive rate.
I sat in on your talk yesterday, and you said something like $97 trillion money supply and global sovereign debt, and to put that into gold would be something like $19,000 an ounce. I don't think you see gold going that high, but I'm wondering, what do you expect for gold?
Well, I think that what that does is it gives you some mathematical, boundaries into which we could begin to carve our expectations. If you were to take all the global, sovereign debt and all the global money supply of just the main industrialized countries, it's almost $100 trillion. That doesn't even include the off-balance obligations, specifically in the U.S., which are quite large. If you did that and you wanted to cover that with gold, if you wanted to go back to some kind of gold standard, gold price would have to be around $20,000 an ounce. We are not saying that gold is going to $20,000 an ounce. We're merely illustrating that the path of least resistance is higher. And when they do print more money, it only adds to that total. And as it adds to that total, that increases the ceiling for which prices could ultimately rise. I could say easily, if you wanted to cover 40% of the U.S., just the U.S. obligations, to kind of take the dollar back to a pseudo gold standard, you'd be looking at least $2,400 in gold, likely closer to $3,000. So that's kind of our long-term target. I like to say you're in a situation where you're not going to wake up one morning and gold's going to be down $100. You could easily wake up one morning and gold could be up $100. So the risk-reward ratio is skewed towards being bullish on the precious metals.
Tell me why you're worried about Japan.
Japan is going to be a real key in 2012. It's something that's not on everyone's radar screen because Europe and the U.S. have really kind of grabbed all the headlines. But Japan has over $3 trillion worth of Japanese government bonds maturing this year alone. That's an enormous figure. And at a time when their current account balance has shrunk considerably because they've entered into a situation where their terms of trade have eroded so dramatically, where they're posting trade deficits now. That's almost unprecedented in the last 3 decades. This really crimps their ability to deal with this debt that's maturing. It's going to be up to the Bank of Japan to print more yen, to take down that debt, to circumvent a rise in interest rates in Japan. And as a net creditor nation, a rise in interest rates in Japan means a rise in interest rates globally. Global economy has not been fixed to the point where it's healthy enough to withstand higher interest rates. So this is potentially a problem. The Bank of Japan, the Japanese yen, the JGB, and the gold priced in Japanese yen are key indicators for me. These are key tells going forward as to how this is going to play out.
So tell us a bit about your business and your newsletter.
Well, we write the Money Monitor. It's our flagship product. It's global macro top down, and we take it bottom up, technical. So we kind of blend the fundamentals with the technicals to reach, some conclusions on market sectors. We're bullish metals, we're bullish energy, or we're bearish stock indexes globally. We also do the Metal Monitor, which is gold and silver specific. It's an audio-visual product where we go through charts and talk about the market. And we do the ETF Playbook, which covers the equity area in the ETF universe. We also manage money. We run a CTA, Commodity Trading Advisory. We have 2 programs. One is our macro discretionary program, where it is basically taking the themes, fitting them into the trading models and coming up with our strategies. And we also have what we call the long-short commodity program.